Construction jobs crash, driving up unemployment. Let's have a look. Good evening, everyone. Florian Heise here, and welcome to another episode of Heise Says. I hope you're having a good Sunday, relaxing before you head to work. I've got my Stein of Guinness here. Yes, I'm still working through that six-pack I bought. One of the days where that'd be, one night's worth of drinking now. It's much slower, but it tastes so good. Not sponsored, but I wouldn't mind the opportunity. So, guys, let's have a look through this article. Because for anyone in the industry, I don't think it's going to be too surprising to those of us that talk around and get a feel or a vibe of what's happening. So, construction job losses likely to push unemployment higher and interest rates lower. Well, the interest rates will be a response to an increase in the unemployment rate. Right now, it's sitting at, 5.2%? I prefer the Roy Morgan approach, which is their methodology pegs it at over 8%. Essentially, you take the ABS number and double it to roughly get an understanding of what unemployment actually is. So, if unemployment is the fulcrum on which the Australian economy is delicately balanced, then the increasing loss of construction jobs may well be the weight that drives things down sharply. The unemployment rate has crept up from its recent low of 4.9% in February to its current level of 5.2%, with the construction industry in large part responsible for the rise. Around 50,000 construction jobs have disappeared over the past 12 months, as the sector's share of the total labour market shriveled to 9.1% from its peak of 9.5% early last year. This doesn't sit well with the creation of more than 330,000 jobs across the economy over the same period. That's really concerning. Guys, let me know in the comments. We've had a few people mention that they're, being made redundant or at risk. I'm getting more and more emails from random builders trying to get tender work from a tiny architectural practice. More students are sending emails out. So, what's the vibe that you're getting? I've been speaking to colleagues and friends that are patchy. The one thing when you talk to engineers, it's always, if they have one or two big jobs, all the little stuff is the cream that just keeps it all running. But if those big jobs aren't there and it's just all little stuff, then that gets a bit worrying. Even the struggling retail sector managed to deliver a marginal rise in its number of jobs, while manufacturing and the information and media sectors have endured a tougher year for lost jobs in percentage terms. It is construction's size, the third largest industry behind healthcare and retail, as well as the speed and breadth of its slowdown, which makes it pivotal. Well, yes, it happens quick. Callum Pickering, Asia-Pacific economist at the global job site Indeed, has delved into the data and found things that are likely to get much worse. With Australia's residential construction boom in the rear-view mirror, construction job opportunities are suddenly limited, Mr. Pickering said. A latest boom has now run its course, and activity is expected to decline further over the next 2 years. Naturally, there is worry about construction jobs. Indeed, data suggests there is good reason for concern. The number of construction job postings per million posts were down 35% in August from its peak in December 2017. Construction employment topped out in February 2018 as the share of total employment, while construction activity began falling off a few months later. This is why I'd like to do a kind of like a PMI for the architectural industry to see what's on the drawing board and what their work is like, because that's a foreshadowing to what's happening in construction and the trades, even before building approvals. So, residential, engineering, and non-residential residential construction rose almost 50% from 2012 to 2018. Well, there you go. Remember in 2016, that's when we had, over 90% of building approvals? How much of our GDP then? It was already going down. So, unemployment keeps edging up. This week's jobs data will be central to the immediate future of interest rates and borrowing costs. A benign result takes a bit of pressure off the Reserve Bank in the short term at least. A shocker and an October rate cut is very much in the frame. Given key forward-looking indicators such as job ads and vacancies are getting weaker by the month, unemployment kicking up another notch is a distinct possibility. Equally, the glaring weakness in private sector demand displayed in the recent GDP numbers and a sub-trend business condition do little to inspire confidence that employers are about to employ more. Yes, exactly, let alone drive up wages, as everyone seems to think will happen. For the record, Westpac has forecast that 42,000 jobs blockbuster in July is unlikely to be repeated in August, penciling in a more modest 7,000 new jobs, and keeping the participation rate steady would see unemployment hit 5.3%. Okay, so that means it would track up. That makes the RBA's ambition of reaching full unemployment at 4.5% more forlorn, and kicks the possibility of a decent pickup in wage growth further down the track. I think the idea of wage growth isn't going to happen in the foreseeable future, not for a while anyway. You know, ANZ's David Plack also sees unemployment ticking up this week. We think RBA will have little choice but to ease further over the coming year as the impact of the sharp domestic slowdown feeds into the labour market, Mr. Plank said. However, Mr. Plank said the timing of rate cuts will depend on whether the weakness becomes apparent, with the recent rebound in house prices acting as a counterbalance. Does it? I mean, it's just I would argue, bear with me, perhaps it's to do with the fact that we've had the sudden rate cuts. We've had a easing of borrowing standards, and we've had a reduction in the supply of goods, houses. So the prices have spiked up. Will that counterbalance the unemployment in the construction industry? How? And will the RBA take, or is it he's saying the RBA will take that into account? Is that the point? Maybe I need another Guinness or a Kilkenny. I need to do a Heise Says German Club night. We need to, have a meet up there, guys, and just have some wheat beers and regret drinking. So on the face of it, this strong housing market weakens the case for further rate cuts in the near term, but we expect a weak employment report next week, forecasting unemployment to rise 5.3%. This, in our opinion, will offset the strong housing data and force the RBA's hand in October. A stronger employment report, in contrast, would delay the RBA's next cut. So labour intensive. While construction has ridden a wave of booms and busts over the journey, the slowdown this time around could be acute given it's centred on residential construction, Mr. Pickering argues. Residential construction is more labour intensive than engineering construction, which means that $1 billion of residential construction creates more jobs than $1 billion of engineering construction. Yes, that's 100% right. That's likely why employment in the sector held up surprisingly well despite the extraordinary decline in engineering construction from 2012 to 2016. Residential builders still have plenty of work on their books, just not enough to sustain all the jobs created in recent years. While there are still plenty of projects in the pipeline, the number of new ones isn't enough to offset those being completed, Mr. Pickering said. The declining demand for construction workers may explain why wage growth is lower in this sector than in most other Australian industries. However, Mr. Pickering notes there is a saving grace for construction workers. They tend to be far more flexible and their skills more transferable than workers in other sectors. Yeah, I could see that, to be honest. A lot of them are problem solvers. Problem makers too, but problem solvers as well. That stuff up, it's not a stuff up, it's a feature. So this places them in a favourable position, even if construction opportunities keep on falling, provided that job opportunities in areas like production, maintenance or engineering don't follow suit. And right at the moment, that is a very big if. The pace of job creation is slowing markedly, from an annual growth of almost 3% in May to 2.4% now, with Westpac arguing it will be close to 2% by the end of the year. Markets extend their rally. Global equity markets continue on with their fairly solid September rally, which has seen them put on around 3% since the start of the month. Wall Street took a bit of a breather on Friday, despite stronger than expected retail figures, and the thermostat being dialed down on the US-China trade tensions. The real action was on bond markets, where US Treasury yield jumped after a couple of conciliatory trade gestures trickled out ahead of the planned US-China trade talks next month. China exempted some US goods from its new tariffs, most notably pork and soybeans, not surprising given the soaring food prices in China at the moment, while US President Donald Trump said he was open to an interim trade deal. Not surprising given ratcheting tensions up doesn't seem to help either his approval rating or the stock market. Yields on 10-year bonds posted their biggest weekly increase since 2013, while on the short and 2-year bonds experienced their sharpest rise in a decade. All in all, the yield curve, as they say, steepened, a move further away from the recent flotation with inversion, a sign the market is betting the risk of recession risk is easing. Okay. Cuts a couple of holes and a hike. So it is a very busy week on the global central bank calendar, and expected cut from the US Federal Reserve, the main event, despite a generally strengthening domestic economy underscored by last week's strong retail figures. A cut from the Fed is all but certain. What is less certain is the prospect of more cuts, which the market has priced in. While trade tensions and global growth have deteriorated since the Fed's last cut in July, US growth and inflation appear to be on a more solid footing. It is a delicate balance. If the Fed indicates there are more cuts on the way, markets are likely to roll on happily. A sniff of hawkishness may signal another retreat. Elsewhere, the Swiss National Bank is expected to match the ECB's cut, if for no other reason than to try and keep a lid on what it calls its significant overvalued currency. The Bank of England also meets this week, but has little alternative but to hold, given the ongoing uncertainty over Brexit, according to Citigroup's economics team. In case of a deal or Brexit being reversed, rate hikes would follow, given how tight the labour market is. No deal Brexit would probably trigger rate cuts and a new round of QE, Citi wrote in a weekend note. The Bank of Japan probably won't cut either, given it's already below zero. Norway looks like following a contrarian path. The Norges Bank is expected to lift its key policy rate up a notch to 1.5, with the possibility of additional hikes down the track. So it's going to be a busy week, and no mention, probably because it didn't occur when the time this article was written, of the drone attack that happened in Saudi Arabia. So I will be very interested to see what happens to oil futures. Anyway, guys, how are you handling this in the construction industry? What are your strategies to deal with this if there's a declining in work for you? What's your backup? Let us know. Anyway, like, share, and subscribe, and relax on your Sunday night with your Steiner coffee or your Steiner Guinness. I'll see you next time. Take care.